All right, I think we're live here. The clock has struck 11:30 in Chicago, so we are going to get started. I'm Craig Buick. I am the global head of retail education at CME Group, and I'd like to start today first by thanking Plus 500 for the opportunity to do this. We've been working with Plus now for a couple of years since they began offering futures to their US based clients. But this is the first time I've gotten to work with them in a situation like this in a webinar. And I'm really excited about it. I hope this is the first of many that we get to do with Plus. They've become a very important partner to CME in really just a short time. So I'm excited about this. Like I said, I want to thank them for the opportunity. I also want to thank Bobby Iacchino, and I'm going to let him introduce himself in just a second. But I've worked with Bobby a lot over the last couple of years. Always fun for me as well. I always get to learn something when I work with Bobby, so you're never too old to stop learning. So it's always fun to work with him. And most of all, I want to thank everyone for being here. It's never lost on us that we all have busy lives and that you've chosen to spend a part of your day listening to what we have to say about futures and CME Group. So sincere thank you to everyone that's here. Bobby, if you want to go ahead and introduce yourself quickly.
Yeah, thanks again, Craig, and thanks to CME and to Plus 500 especially for having one of these. If you're a client of Plus 500 or you've attended any of their webinars before, you've probably seen me because I've done a couple of these with these guys, and I love working with these guys. I look at the platform all the time. They have such benefits on this platform that we can go into, or you can just research them yourself. But the number one being the unlimited demo, which I think is really, really important for people. So my name is Bobby Iacchino. And I am a futures trader. I'm also an analyst and I have my own analytical company. I traded futures before I traded anything else, and I traded them at the CME on the trading floor. So I started on the trading floor in 1993, didn't start trading until about 1997, and wasn't that good at it to start. And for that reason, I think I have a decent amount to add to what you guys are trying to do, because I assume you're all here because you're trying to be traders. I've been doing this for about 33 years, and I still succumb to a lot of the things that I'm sure you guys kick yourselves in the butt for when you find yourself doing it. I still do it. I still make mistakes, get out of trades too early, things like that. Um, but you're doing the right thing if you're trading futures. If you're learning to trade by demo trading futures, or if you're actually already live, this is the right place to be. I had a very famous trader, a guy by the name of Monroe Trout. He's in the original Market Wizards book. When I first met him, he said to me, "You're a futures trader?" I said, "Yes." He said, "That's good because real traders trade futures. That's what they trade." Okay, everybody else trades stocks and everything else. Not to disparage the other assets, but this is where you want to learn. And these are the products that you want to pay attention to develop your style of trading. So that's enough about me. We're going to be talking about a lot of things here. If I can show you the sort of table of contents here. This is, I guess we're the experts here, Craig, on the CME's hottest products. We're going to talk about the CME's role in the global futures landscape, who, what, and how, or who, why, and how, I should say, about futures trading. We're going to talk about CME products with Plus 500 and on Plus 500's platforms. Then we're going to do a little spotlight on crypto futures, spotlight on gold, some of the biggest things that are trading right now. We're going to do a little comparison of gold and crypto from a perspective of trading them and how they look in the markets and how they behave. And then we'll look at some of the weekly market trends before we go into a little bit into Plus 500's program. So if we can move on to the first thing, Craig, I think this is going to be you.
Yeah. Yeah, let's stop here on the disclaimer real quickly. I'm not going to read it word for word, but what I would say is that CME has developed what I would consider a pretty world-class educational portal called CME Group Institute. And I would encourage everyone to go check that out because whether you're just getting into futures or you've been doing it for years, there's stuff out there that I would consider 101 level all the way up to like what I would consider graduate level work in futures and options on futures. So check it out. I don't think there's any such thing as knowing too much. And again, it's CME Group Institute. And if you Google those words, it'll take you right there. So that's good for the disclaimer, I think. And we're going to start real basic here, which is really what is CME. And sometimes I hesitate to go that basic, but then I go to a lot of industry events and people come up to our booth and they'll say, "What do you guys do?" And having been in the industry for 30 years, it's kind of second nature to somebody like Bobby or like myself. But it strikes me that not everyone knows what CME Group is, even though what CME Group is the largest futures and options exchange in the world by most measures. And what that means is that a lot of times I'll describe it by saying CME is to futures what like the NASDAQ is to stocks, or what like the New York Stock Exchange is to stocks. So we are simply the exchange on which these products like the E-mini or micro E-mini S&P or the micro NASDAQ, we're simply the exchange on which they trade. We're not the broker. You don't open accounts with us, but we're the exchange that allows you to trade those products. And that's why it's so important for us to partner with firms like Plus500, because they're essentially our distribution network for the products that we have. So that's what CME is. And like I said, from most measures, it's the largest futures and options exchange in the world. Not only is it the largest, but I would say that I would contend that we have the most diverse product class or asset class among any futures exchanges globally. And what I mean by that is that you can trade everything from a short-term interest rate called SOFR that you probably don't even know what it is, to a stock index like the S&P and NASDAQ, to a treasury, to a foreign currency, a metal like gold, WTI crude oil, and then things with feet, all the way to things that have feet like cattle and hogs and things like that. So we have, and then cryptocurrencies is actually our newest, I guess what I would call our newest asset class, which we're going to talk about a little bit today. But all in all, we have 7 different asset classes. And the reason I think that's important is because they're not necessarily correlated asset classes. So, stocks at certain points might be correlated with gold. At certain points, they may not be. WTI might be correlated with foreign currencies, but they may not be. And what that means is that if you're a trader and you're looking for something that might be moving at that time that has some volatility, the chances of finding something like that at CME is simply greater because we have this diverse set of products. I don't know if you want to add anything to that real quickly, Bobby, before we move on.
I do. One of the main reasons that I'm still focused, again, I trade everything now, but the thing I trade the most is crude oil futures. And if you amalgamate everything that I trade, I'm easily 70% futures when I trade. And the reason is a line I'm going to steal from our mutual friend Paul Craig that he said to me years ago. Futures offer you pure exposure to what you're looking at. So, for example, if I look familiar at all, it might be because you used to see me on CNBC or Bloomberg or Fox. I don't do much of that anymore. But I remember being on CNBC once, and I told them that I thought crude oil was going higher. And they said, okay, so what stocks are you looking at? I said, no stocks. I'm looking at crude oil because the only thing 100% correlated to crude oil is crude oil. So when Craig talks about correlation to products, you're looking at a position in crude oil. People who trade stocks tend to look at an energy company. If you're looking at a particular movement in gold, they tend to look at miners, right? Natural gas, you might look at an LNG company in the stock market. That to me has never made any sense because when you're looking at futures markets, whether it be currency futures, whether it be commodity futures, whether it be the micro ES or the micro NASDAQ, those are the exact product you're looking at. And to try and be like a little too cute about it and get outside of the products that the CME offers, 90% of what you're going to want to trade is offered at this exchange, and it's offered through Plus500. So you don't really have to go anywhere else. And it's why if you learn to trade in futures, you become a better overall trader, in my view.
Totally agree, Bobby, and I'll concede. I know you conceded that you stole a line. I've used your line a million times on stage and in webinars, which is what's more correlated to crude than crude. And you're absolutely right, because when you're trading crude futures, it's going to converge to that cash price expiration. It is literally crude oil is what you're trading, not a company like Exxon, which may have whatever. So, it's going to probably be correlated to crude, but not always, and certainly with some other factors. And so I totally agree. I'm going to go over this really quickly. This is kind of how CME got to be where we're at, and I'm going to be careful to spend just a little bit of time because I can kind of geek out on this a little bit. I was born and raised in Chicago. I think the Board of Trade and the CME have a great history. It's a great Chicago history, so I got to be careful not to spend too much time on it. But we were founded, or at least the Chicago Board of Trade, which CME later acquired, was founded way back in 1848 as a grains exchange. So literally a place where farmers would come to hedge the crop that they had. And we were actually a commodities exchange all the way up to 1972 was actually the first year during which a financial future contract was introduced, and those were foreign currencies. So all the way from 1848 until 1972, these exchanges were commodity exchanges. It wasn't until then that we actually became, the foundation at least for what became a global financial marketplace. Then some of the other, big ones in 1997, we launched the E-mini S&P 500. And little history lesson, if we go back to 1997, the S&P contract that existed then was what we called the standard size or just the regular S&P 500, which is a contract worth 500 times, if you can believe that, the value of the S&P index. So if you fast forward to today and look at the value of the S&P index today, that would be a monstrous product. And we obviously don't have that anymore. Now today, what we call the E-mini, which really isn't really a mini anymore, is our bigger size S&P contract. In 2002, CME went public. So we were the first US-based exchange to go public in 2002. 5 years later, in 2007, CME bought the Chicago Board of Trade. In 2009, we bought the New York Mercantile Exchange, which got us into the energy trading business, and the COMEX Exchange, which got us into the metals trading business. And then in 2018, we acquired a company called Nex, which was our first venture out of futures and into the cash market, which that got us into the cash treasury bond and the cash foreign currency businesses. And then kind of one of our more recent major announcements was a partnership with Google back in 2021, wherein we're going to essentially put our match engine in the Google Cloud eventually. So that's kind of a very brief history on how we got to be who we are today. And when you hear CME Group, the reason we're called now CME Group is because it's not just what used to be the Chicago Mercantile Exchange, but it's now essentially a consolidation of the Chicago Board of Trade, NYMEX, COMEX, and NEX, and then obviously with the partnership with Google. So, Bobby, I know you've been around for a long time. It's a history that I feel fortunate enough to be just a small part of. This kind of Chicago history, and I don't know if you want to comment on that because I know you've been around for a long time too.
Yeah, it's interesting. There used to be a program on public television called Nova. And I don't know if it's still around or not, but if you go to YouTube and type in Nova Open Outcry, the first 15 minutes of that documentary on the trading floor, which was in the Eurodollar pit in the CME for most of the documentary, you'll see me on the trading floor with no beard, with my trading coat on, with my Jerry Seinfeld hair. And it's interesting to me because I still have my badge behind me on the shelf here in a frame. I wasn't supposed to take it, but I did. Craig, don't tell anybody. And it's a point of pride for me that I worked down there, that I experienced that. Open Outcry will be in the history books as one of the most efficient ways of doing something that then obviously technology took and made more efficient. And the CME was at the forefront of that with the Globex system and some of the other things that they came out with. So it's been an absolute thrill to be involved there, which is why I always still do things like this. Whenever Plus 500 asks me to do something, I do it. When CME Group asks me to do something, I do it because this is a place that taught me to trade. So you're looking at this slide now of who, why, and how. Why do people trade futures? I don't normally do this because we are going to have a Q&A session in here, but there's a question in the webinar chat. Why does Plus 500 not have spot quoted futures so small traders can get involved more? To me, the way I understand the phrase, Craig, of spot quoted futures is that basically everything here is based on spot, just the future of it. So I'm not sure what this person means by spot quoted futures. And the second thing is the micro futures are absolutely, Mike, Julia, what you're looking for, because it's absolutely how small traders get involved in these markets. But Craig, you want to comment on that real quick?
Yeah, so we introduced a new product, and it's probably as different futures products as you've ever seen, Bobby, a few months back. And they're actually called spot quoted futures. So it's a future that contains all of the capital efficiencies that a standard future does, but it's quoted at the spot price. So what we do is we take into account the basis at the back end. So it's a little bit more complex than some of the standard futures where that, and now we're getting off topic a little bit, where that basis
We
is
are.
built into the price. But they are smaller, and and I think and I don't want to put words in Plus 500's mouth, but it's a developing product, and sometimes it takes a little bit for new products to develop. And my guess would be Plus is kind of waiting for that a little bit. But it's a product that we're excited about, and I think, as long as we can, we're certainly going to keep trying to make this thing go or these things go. And assuming that we are able to develop it, I would assume that Plus will then consider it on their platform. But it is a developing product, and these things do take time, and I think that's probably why it's not on there now.
And it does take us to the question on the slide, right? Why do people trade futures? First of all, I have never needed another product. I've expanded into other products for different reasons that we don't need to go into because they were my personal reasons, right? But I've never needed another product. I still, to this day, when I want to know what the markets are doing, I look at the equity futures. I don't look at the spot. I don't look at where the spot closed and where it's going to open. The futures to me have always represented more of a real market than the actual spot, believe it or not, especially in equities, because they have always been more on point as to where the market was going to be when the spot market opened. But why do people trade futures? So obviously you mentioned the capital efficiencies. Futures allow the right amount of leverage, if you ask me. We've got underneath there hedging, speculation, and portfolio diversification. Most people watching this, in my view, are going to be more interested in the latter two, right? The speculation and the portfolio diversification. I've always speculated in futures more than anywhere else. Why? Because the micro contracts, especially now, number one, allow me to fine tune speculating and or hedging, but we can get into that in a minute. And the portfolio diversification, again, I've seen situations where crude oil has been rallying while ExxonMobil fell, right? And you can actually look at that as a hedge or as a diversification for a stance that you have somewhere else in your portfolio. Futures are the best product for that, if you ask me.
I think that's right, Bobby. And to even back up a second and going back to 1848, the most fundamental reason that these futures markets exist is for a hedging vehicle, right? And if you ever watch our chairman and CEO, Terry Duffy, on an earnings call or on a CNBC hit or something like that, you'll almost inevitably hear him say, CME is where the world comes to manage risk. But I also think Bobby's right in that most of the people watching this particular webinar are going to be interested in futures from more of a speculative or a portfolio diversification perspective than a true hedging. But that's what makes the market work, right? There are people in the market. If we break it down to its most fundamental, we have what we call market makers, right? And their whole job is to provide constant bid and offers to the market such that anyone else can transact on any given market. They're pretty much pure speculators for the most part, but they exist within this whole ecosystem of banks and hedge funds and central banks, money managers, commercials, and then, of course, individual traders who all make up this combination of speculators and hedgers and really kind of make the ecosystem complete. And that's what makes the market, and it's what makes the market so liquid.
And we look at it, when we're looking at a chart, and Lucas, you can go on to the next slide if you want to, but when we're looking at a chart, most people will look at a price chart at some point. When you're looking at a chart, it is the compilation of everything Craig just said. So if you're looking at a bull market move, but maybe it's not as strong as you think it should be, that might be because a lot of people involved in the cash market or spot market are hedging against their position somewhere else, and they're putting pressure on the futures market. That's why I say the futures markets tends to lead. If you see a runaway bull market in the futures market before the spot market opens, a lot of the time, not every time, I don't want you guys to put on positions based on this, but a lot of the time, people are unwinding hedges in the futures market prior to what they think is going to go on in the cash market. The price in the futures market is every possible opinion piled into one place, and that's not the case with the cash market.
Yeah, and then just kind of a real quick add-on to that too. I think a lot of people are familiar with our FedWatch tool, which is a tool that uses Fed fund futures to essentially estimate the probability of what the Fed is going to do at subsequent meetings. And it's kind of what Bobby just said. And the reason I like that so much is because it's literally a reflection of what the market is saying. It's not what some economist is prognosticating about what the Fed is going to do. It's literally what the market is saying it thinks the Fed is going to do. Now, it doesn't mean the market's always right, but it's not somebody's opinion. It's literally the market. And I think that's really cool. Let's talk a little bit about, we have got the micro contracts up, and I think what the CME has done in recent years is a good job of in recent years is essentially right sizing. And Bobby mentioned this before, right sizing our futures products for the individual traders. So if you go back to 2019, we didn't have micro equity indexes. The smallest equity indexes we had were the E-mini S&P, the E-mini NASDAQ, Dow, and Russell. In 2019, we introduced what's called the micro version of all four of those major indexes, which were products that were 1/10 the size of the E-mini. So if you fast forward today to 2025, the NASDAQ 100 futures trading around 25,000 points. The E-mini NASDAQ 100 future, the bigger size product, is worth 20 times the value of the index. So a $500,000 contract. So essentially what that means is if you trade one E-mini NASDAQ future, you're essentially getting exposure to $500,000 worth of NASDAQ 100. So you can see why it was so important that we launched these micro contracts 6 years ago, because at 1/10 of that, the micro E-mini NASDAQ is worth 50,000. Not a small product by any means, but much more manageable for a lot of individual traders than the E-mini counterparts are. And we have micros now I think in all 7 of our major asset classes, in all of the major products that an individual would trade. And I think that's really important to point out. We're going to focus on a couple of them, cryptos and gold, coming up here in a minute. But I wanted to point out what we mean when we say micro. And maybe it's worth even backing up one other step, because when I say that the E-mini NASDAQ is worth 20 times the index, the way that futures work is different than stocks. So if you're used to trading stocks, you might be used to trading 100 share increments. And you know instinctively that if the price goes up, if you're long 100 shares of Nvidia and the price of Nvidia goes up by $1, then you make $100. And you kind of know that instinctively. Futures have these things called multipliers. So in the case of the E-mini NASDAQ, that multiplier is that 20 that I mentioned. In the micro, that multiplier is 2. So 1/10 the size. In the S&P, the multiplier in the E-mini is 50. So it's 50 times the S&P index. The micro, of course, then is 5. And that's how you calculate the P&L. And I will concede, it's one of the biggest barriers for people that are not used to trading futures, but might be used to trading stocks, to get into futures. And it's not rocket science. Like, we haven't split the atom with it. It's just simply one of those things you have to learn in order to trade futures.
Yeah, and I'll throw in that, one of the best ways to learn that is Plus500 is one of the only platforms that has live prices on their demo, and they have unlimited demo accounts. So one of the best ways to learn that, like you're sitting there right now saying, well, why would I sit and do that math in my head every day? You don't have to, because there's a tick value for each thing. And you'll be able to watch your demo account go up and down, do one micro contract and just watch it. Maybe don't try and put on an actual trade to begin. Just put on any trade, doesn't matter which way, and just watch the price move and watch what happens to the P&L. It's the easiest way to get used to it. It's how most of us did it. When I was on the trading floor, we weren't sitting there with calculators doing the multiplier, right? We just knew what the tick value was. And this is why I say that the CME group, it's because of that multiplier, that the CME group is able to allow that amount of leverage, right? Talking about managing 500,000 worth of NASDAQ or 50,000 worth of NASDAQ in the smaller contract, you actually don't have to worry about the amount you have in, because you're not putting up $50,000 like you might even in Reg T margin in stocks to put on the QQQ. It would be, 25,000 instead of 50,000. Here, it's a much, much smaller amount, and you're able to do intraday trading and then cover those positions and not have to worry about any sort of complication.
Yeah, when we say margin in futures, we're really referring to what I actually call it. I interchange that term with performance bond. It's essentially a small fraction of the amount of exposure you're getting that you have to put up with Plus500 to say, hey, I'm good for this position. It's not the full amount of 50, and it's not even Reg T 50%. In fact, right now, NASDAQ's probably around 6% of the notional value. Probably around, my guess is around $3,000. It does change with volatility in terms of what you have to put up to hold that position. And the other thing is, if you're trading stocks on what we call margin, and you put up 50% of what you of the exposure you're getting, that other 50% comes in the form of a loan from your broker. A
Right.
performance bond is not a loan. You're not paying interest on it. It's simply an amount of money that you're putting up to hold that position. So it's a much different context when we say margin in futures and margin in stocks. So let's get on to what we came here to talk about. We'll start with crypto. And holy cow, what a time to talk about crypto. I mean, maybe it's a good time, maybe it's not, because I don't know what's happening or what's going to. I just lost the lights in my room. I'm going to get up in 1 second, but I'll let Bobby. We want to talk about essentially like crypto has become. I don't know if I want to call it mainstream, but it's become an institutionally adopted product. It's certainly become a tradable asset class. And
Yep.
one of the things I like about futures on crypto is in order to trade it, you don't have to worry about a wallet. You get that capital efficient nature of futures. And if you want to get short, if you have a view that cryptos are going to go down, shorting it is in futures is just as easy as buying it. There's no
Right.
locate requirement, there's no borrow costs or anything like that. And that's true of all futures. But Bobby, talk a little bit about, the four different cryptos that CME currently offers futures on and really kind of what's going on with cryptos right now, because I can't figure it out.
Yeah, I would say that, well, first of all, let's talk about the four assets you can trade on the CME group, and that's Bitcoin, Ether, Solana, and XRP. I would recommend that if you have not gotten involved in the crypto markets yet, this is the place to do it. It's a regulated exchange. We used to say on the trading floor when we were talking to people about futures that the CME allows futures to be good to the last drop. And what we meant by that was um, the CME's never defaulted on anything that they were responsible for. So you hear about these hacks that go on some of these exchanges. I'm not even going to mention them by name, but there's been some pretty famous ones. There's never been that type of a situation at CME. Okay, so when you're trading crypto at CME, you're trading in a safe environment where billions and billions of dollars fly through there and they're always safe. There's never been a default. So you don't have to worry about that kind of thing. And you can also get used to the movement in the four major crypto products that the CME covers. That's number one. Number two, you have the micro. You can trade Bitcoin Cash in smaller amounts, but I prefer the micro because for me, it's a very tradable asset. I'm not sure at this stage in my career if it's something that I want to long-term buy and hold. So I afford those types of opinions into the futures market rather than at a place like Coinbase or a place like that where I might have problems down the road that I can't foresee. I've been involved with the CME group again for over 32 years. So for me, it's a completely comfortable place to get my feet wet in crypto, and you've got the micros again. Now, in terms of what's going on in there right now, one of the issues I have with Bitcoin, and this is interesting, Craig. I'm going to be speaking at a symposium with a bunch of crypto devotees, and I'm the counterpoint to their point on November 6th down here in Southwest Florida. And I'm going to be wearing plastic apron and stuff because they're going to throw tomatoes at me, I'm sure.
Crypto bros, if you will.
Yeah, exactly. But one of the things that bothers me about crypto specifically is, and we saw it last Friday when President Trump talked about possibly increasing the tariffs on China, right? We saw a massive sell-off in equities except gold. Now, crypto devotees, I'm going to call them, will say that Bitcoin is the new gold. Well, it didn't act like the new gold on that particular day. Now, I say that it's still too highly correlated to the NASDAQ to the downside. And what do I mean by that? Generally, not always, but generally, when the NASDAQ goes down, so does crypto, so does Bitcoin specifically. Today, we've got the NASDAQ up by almost 2/3%. We got Bitcoin down by 2%. So that's what I mean by it's correlated to the downside, not necessarily to the upside. It needs to lose that correlation, I think, before it becomes the serious asset out there in terms of flight to safety movement.
Yeah, because you heard about is Bitcoin is the new digital gold, and at certain times it does have some of those elements, but I think to your point, it's not consistent in that point yet, and in fact, sometimes it becomes completely uncorrelated to gold, which
Yeah.
at that point you can't really rely on that as a store of value or kind of like the inflation hedge that gold is. So I think that's right. And just kind of talking about the micro cryptos, CME launched its first cryptocurrency future, which was what we call the standard size Bitcoin future back, I think it was in 2017. So I feel like
Sounds
CME
right.
was, if not ahead of the curve, was right on the curve in terms of institutional adoption of cryptocurrencies when we launched that future. Now that was a Bitcoin future that's worth 5 Bitcoins. So at today's prices of what, 100, let's call it 110, that's $550,000 worth of a pretty volatile underlying asset. So that's a huge, huge product.
Can I
But
interrupt you
we've
for
also,
one second,
yeah,
Craig?
yeah.
Just for one second, I remember when the CME came out with that, and that was the first indication for me because the CME was the very first in my memory of what you would call old school finance to institutionally adopt and sort of give credibility to Bitcoin by launching that product. Go ahead. I'm sorry.
No, I think I agree with that. And and since then, certainly like I don't think you can find a financial institution that's not using cryptocurrency or Bitcoin in some way. But I think we were at least near the forefront, if not right on the front of that curve. So, but moreover, I think, and certainly for an individual or retail trader audience, the micro cryptos are very important, right? Because whereas the big Bitcoin is worth 5 Bitcoin, the micro Bitcoin is 1/10 of a Bitcoin. So instead of, I don't even know what, like I said, how much, I don't know exactly what the price is, but a micro Bitcoin at 1/10 of a Bitcoin is worth, let's call it $11,000.
Mhm.
Um, we also have one future product that's even smaller than that called the Bitcoin Friday future. I won't get
Mhm.
into all the specifics, but that's 1/50th of a Bitcoin. So essentially about $2,300 worth of Bitcoin instead of the over $500,000 that the bigger Bitcoin is worth. The micro Ether is a contract that's actually worth under $1,000. And then the micro Sol and the micro XRP are about $5,500 and $7,000 respectively. So again, these micro products, particularly in the cryptocurrencies, I think are really important as an access vehicle to individual traders, simply because they're volatile assets. Even though the volatility of Bitcoin, and that might be the next chart actually.
And actually, I want to throw out that my friend Tommy Grisafi, who's in here, I didn't know he was in here, said Bitcoin's right at about 111,000 right now.
111. So what is that?
Yeah.
555,000 maybe?
Yeah. Right around there.
$555,000 times
Right
five.
around there.
Maybe I'm messing up my math. 565. Anyway, I wanted to show this slide quickly. This is a chart of implied volatility. Implied volatility is in options, a measure that we use in options pricing. And we could do a whole hour on what implied volatility is, but for these purposes, implied volatility is simply a measure of how much movement the options market is going to occur in the underlying futures market in this case over the next X number of days. So this is 30-day volatility. So it's essentially saying it's not what has happened in terms of price movement, it's what the options market is saying it thinks is going to happen. Now you can see when we launched Bitcoin, it was by far, not even close, the most volatile product on our board. That's the orange line there. The green line is crude oil implied volatility, and the blue line is NASDAQ implied volatility, which tends to be among the more volatile of the four major equity indexes. And you can see the vol in Bitcoin used to dwarf the other two. You can see as it's become more of a mainstream investment vehicle or asset class, it's actually kind of the volatility is sort of normalized, and in some cases actually traded below that of crude oil. And I think that's interesting because I think it does further suggest that it's really become an institutionally adopted product, become more mainstream, and I think it's reflected in some of the vol.
You definitely need volatility, I'm sorry, liquidity to temper volatility, especially on a new product. And again, you can see the general trend down started about when you guys came out with the big Bitcoin future, approximately, right? It's obvious. I mean, that's where you start the chart. But when you look at it as we get into or towards it now, I used to always say that crude oil was the most volatile thing you could trade until crypto came along. And that may be flipping here a little bit. And that has a lot to do with what influences crude oil versus what influences Bitcoin. If you don't mind, I'm going to quickly show a chart. Lucas, I don't know if I could do that right now, but I'm going to just show a Bitcoin chart really quick if I could. Um, all right, I'm going to send the request to show the chart. If I share this chart right here, and the only reason I'm sharing it at this point is because I want to be able to point something out. Can you guys see my chart?
Yep.
Okay, so this is a 4 hour chart of the micro Bitcoin. Okay, so and this is on the Plus 500 platform. And one of the reasons I'm showing this is because you actually have a pattern developing. We have gold higher and we have Bitcoin lower. We have the NASDAQ higher and we have Bitcoin lower. But we do have a potential reversal pattern on Bitcoin on the 4 hour chart. And it's right here. It's this double bottom. Okay. You can see I've got one bottom here, so I can get control of my mouse. It looks like the low is about at 110, 285 on here. Then you've got the top, which I would call the peak here. And that looks like the high is about 112, 810 or so. No, I'm wrong on that. The high is about 114, 120. And then you've got the right-hand bottom here. So if you're looking at a double bottom pattern, they make a W. Okay, that's just the easiest way to look at it. Visually, there's going to be a W if it triggers. Now, what I call this as a trader of these patterns is a potential double bottom. If we trade above this high that happened right around 2200 on the 14th, okay, that's going to be a confirmed double bottom. If we close above it, it's a triggered double bottom. And that's when I would start to look to get into a trade here. One of the things I like about these patterns, first thing you want to look for if you're developing a double bottom pattern, by the way, the reason I'm bringing this up now is because gold is higher, NASDAQ is higher, but Bitcoin is not. A lot of people would expect all of those three things to move together. So that starts to get me ready to trade this if it were to trigger. Okay, now I'm not telling anyone else to do it. But if we get a close above this particular high, you can now measure out the target on this. And the way you measure it is you take this high, subtract it from this low. This low is about 110, 285. So if you come up with that, you're looking and you add it to this high. And if you're doing that, you're looking at a level of about 115, 595 as a target for that. And then possibly a continued move. That's all I really wanted to show here. Gold is running away. NASDAQ is running away. There's the potential, but not the guarantee of Bitcoin to play catch up here. That's really the only reason I wanted to share it.
That's great, Bobby, and it's a great segue into gold, which was the other product that we wanted to cover today. Which I don't even know what's more relevant, if it's more relevant to talk about Bitcoin and cryptos right now or gold, and incidentally silver, which is also making new all-time highs as of yesterday or the day before, I think, which was a long-standing all-time high for silver to eclipse. I think it goes back to
In
the
2011, I
Hunt
think.
Brothers thing,
Yeah.
way back. So I mean, both of these precious metals have been just on a tear. And it's weird. To me, it's a little weird because they're on a tear at, like you said, at the same time that NASDAQ is making new high. Well, essentially all four major stock indexes are making new highs. So it doesn't feel like a flight to safety, right? As the stock
No.
market eclipses new highs, rates are kind of just sort of staying around where they're at, relatively low. I mean, given recent history, what's going on in these precious metals, Bobby? Because something seems to be.
So one of the standard things I do, I look at 29 charts in the morning. Okay. And then the 30th thing I look at is that CME Fed Watch tool that you mentioned earlier. Okay. And I could show that on the screen in a few minutes also. But what that tells me is not only has the probability for a rate cut in the October meeting for the Fed changed, and it actually has slightly. Um, and then I can also look at, there's a probabilities tab on that page where I can look at what the market is expecting to happen down the road for the Fed. Gold is not a pure inflation hedge. A lot of people think it is. It's an inflation hedge if the Fed is not fighting inflation. Now, that's the little caveat to it. If the Fed is fighting inflation, that means theoretically they're hiking rates. And if they're hiking rates, gold now has competition in terms of a safe investment. And that's treasuries, where rates are going higher and higher. You could put your money in there and earn a yield. You don't earn a yield in gold. Gold is the ultimate flight to safety asset because you can leave your money in gold. And yeah, you can lose the money, right? But you still have the gold. So you're actually holding your money in your hands in theory. If you're trading it in the futures, you're holding it in the most secure place possible, which is the CME. So it is a pure flight to safety asset. Now, it is also a physical asset. One thing people don't realize in inflationary environments is there's this thing called asset inflation. So if you look at the previous periods of actual, you don't have to even have to look at runaway inflation, just little batches of inflation. The price of beef goes up, the price of rice goes up, but so does the price of a car, so does the price of a house, so does the price of your stock investments, and so does the price of gold, unless the Fed is creating competition for gold by hiking rates. Right now, we have a situation where it is likely the Fed is going to cut rates. Inflation is not beat yet. It's still well over 2%, whether you're looking at the PCE or the CPI. So gold becomes an investment there because you have an potential inflationary environment with the Fed not fighting it. Some might say the Fed's allowing it to move in that direction. That's why gold is on such a tear. The secondary effect of that is that central banks are buying it. More specifically, China, 11 months in a row of China accumulating gold. Now, you might think, wow, China must be the biggest holder of gold. They're not, they're seventh. So they might be playing catch up, which tells people who look at gold as often as I do, they're probably going to continue to buy it. So there's a lot going on there in gold, but most of it is, let's call it long-term bullish for gold. I don't want to say that gold's going to go up tomorrow or the next day. As a
Yeah,
matter of
yeah,
fact, right
that's
now, it
fair.
seems a little overdone to me.
A remarkable run for sure. When you look at the charts, it's just a remarkable, just kind of hockey stick up. And I think it's worth pointing out too that the three major futures products that CME offers, if you want exposure to gold through futures, is what we call the standard size gold, which is a contract worth 100 ounces of gold. So at $4,000 an ounce, that's $400,000 worth of gold. We have the micro, which is 10 ounces of gold. So again, at 4,000, that's $40,000 worth of gold exposure. And then more recently, we've introduced we essentially a 1 ounce version of gold futures, which is just what it is. So if you're trading 1 ounce and gold's trading at $4,000 an ounce, that's $4,000 of exposure that you get with one futures contract. So I think, regardless of how much exposure you want, I think we've got a product kind of for everyone in gold when you look at those three different size futures products that we have.
And this is where somebody like me can come in and talk about hedging, which I said is probably not what everybody's talking about. My family as a whole has quite a bit of physical gold, some inherited, some purchased. I bought my first gold coin in 1986. I just thought it was cool. Um, we have physical gold. You can sell a micro gold contract to hedge one gold coin. For example, you sell a 1 ounce gold contract to hedge one gold coin if you think it's overdone. Speculating, yes, definitely. I mean, a lot of people speculating gold at the CME because it is again, the most real exposure you can get to gold. The gold ETFs don't do it. A lot of them don't hold just gold. Some do, but not all of them. They hold gold and derivatives of gold and options on gold. And so if you're looking
Yeah.
for the exact movement, both up and down, this is the place to get it.
Let's say whole lead a lot. You can use. I like
Yeah.
trade around. You've got core long position, but you've got a view that it's overdone. You say you can kind of position that is sort of established long position is kind of how I look at
I'm
it.
going to be a little bit esoteric. I mean, I'm sure I can explain it. Sometimes on the futures, and I can only do this in the futures, but you guys will understand why. Sometimes trade around a core position that I have in the futures with futures. For example, I may be looking at a daily or a week chart and say, wow, this is a really good long-term trade in crude oil, right? So I put on a crude oil trade in the micros. Maybe I put 10 micros, right? I see a short trade. That is not going to stop me out of is an opportunity to add a couple of dollars of alpha, right? So I might sell two or three of those micros. And I'm looking at 30 minutes when profit, I buy establish my entire long-term long position. Try doing that anywhere
Yeah.
else. You just
Yeah.
can't do it. You just can't do it because you can't go borrow the stock and blah, blah, blah. It's just a lot more difficult. It's a lot more difficult to
That's
manage the
exactly right. And then
position.
to reiterate too, if one of the basic tenets of futures is that idea that if you want to short something, you sell it. If you want to get long it, you buy it. And it's really that simple. There's no locate requirements, there's no borrow costs, there's none of this. It also, if in going back to like the cryptos, for example, or even the precious metals, if you want to play one against the other, it allows you to do that very simply because of the fact that shorting it so easily. So if you had a belief that, Sol was going to outperform XRP, for example, then you could get long one and short the other just as easily.
Yeah.
Or if you thought that silver was overdone in the short term and gold was going to appreciate versus silver, you could do that kind of trade as well. So what we call relative value trades become very, at least operationally or mechanically, very easy to execute using futures. I think, Bobby, we've kind of covered that sort of gold Bitcoin relationship. If we want to go to that correlation slide, just to point this out, because I think it underscores exactly what Bobby was saying. The correlation isn't that strong when you really get down to it. And in fact, over the last 6 months or recently, if you look at a 6 month correlation recently, it's actually gone negative. And I think you might have even pointed that out, Bobby.
Yeah, the correlation has moved quite a bit. And I've seen this in a lot of things. For example, the CME has a WTI crude oil contract and they have an RBOB gasoline contract. I actually just wrote an article recently about how they aren't always correlated. People will hear on the news that the price of crude oil has gone down, but then they go to the pump and the gas prices have not dropped at all. And in some cases, they've increased. There are different things that affect different asset classes. And that's why I
Yeah.
say gold and Bitcoin. Bitcoin has not proven its digital gold yet. It's the closest thing to digital gold. Um, no, what's the closest thing to digital gold? The CME gold contracts. That's something else I talk about all the time is if you don't actually want to buy physical gold, you probably want to trade CME futures contracts because again, these correlations are not a trading strategy. There's something to know, there's something to pay attention to, similar to seasonality. There's a lot of seasonality you guys might look at. Like, for example, gold is in a weak seasonal period right now. You might not believe that because it's going higher, but that just underscores that these things are not trading strategies, right? The highest or the strongest seasonal period for gold starts around mid-November and then goes through the holidays for obvious reasons. People buy gold as gifts. It's also a wedding and festival season in the largest consuming countries for gold, which are China and India. So these correlations are important to know, but they are not a trading strategy in and of themselves.
Yeah. I love it, Bob, and I'm glad you brought the W. There's so many different what we call relative value or spread trades that are available with futures with CME futures, and you mentioned the RBOB WTI. We call that the crack spread because of the way that WTI crude oil is turned into gasoline, and that's a great example, right? Because let's say a major refinery is taken offline for some reason, whether it's a natural disaster or a mechanical problem or whatever. Well, the WTI crude is still there but they can't turn it into gas. So you
Right.
have the supply disruption to gas, which could theoretically cause the price to go up, but the crude is still there, right? We don't have supply disruption to crude. So it's just something like that. And there's so many so many interesting and different trades that you can kind of put together with futures. And I'm glad you brought that one up because we don't talk about that one a lot. But it's interesting to me is something to
Yeah.
look at. So I think we've kind of touched on market trends. I mean, it'd be tough to single one out these days because we've got volatility, at least sporadic volatility injected back into the stock market over the last several days with some of the tariffs and things like that, and the news with China. Gold is we've talked about crypto, we've talked about and so I think we've kind of covered kind of like what's moving in the markets. I don't know if you've got any other thoughts on that, but I mean,
No, I've got one more thing. So on this what else tab here, I'm going to put up two quick things here, if I could, Lucas. I'm going to share the crude oil chart on a daily basis real quick. And that is again, just to show you, this is the full size crude, or I'm sorry, the micro crude, which again is one of my favorite things to trade. Craig, you're seeing it?
yep.
What we're seeing right now on a daily chart is declining volume with declining price. So you could see a move to the upside here, but unlikely that we break out to the upside above this sort of line that I'm focused, that I'm kind of drawing with my crosshairs here. It's probably going to be a rally to there and then a move back lower. That's important because it comes into play. This is one of the most important factors for inflation is energy. All right. So I always like to point this out to people. The volume has been pretty dramatic. One of the things I really like about this platform is I can run my mouse over a particular day here. You can see 65.9 on the volume in that little box there. If I go to point to it, it'll disappear on me. It's like right about there. It doesn't matter. And then you can see it up on the left here, 48.5 thousand, 43.8 thousand, 33.5 thousand, and so on. So we're moving to where the volume is dropping off as the move continues lower. That's always something to keep an eye on. And then the last thing I want to share, and I'm going to stop sharing to do this and then reshare, is that CME Fed Watch tool you talked about. And then I've kind of worn out my welcome here before to get to Q&A if there's any here. This is the CME Fed Watch Tool. And the easiest way to find this is just go in whatever search engine you use and type in CME Fed Watch Tool. This is one of the first things that I look at in the morning, along with the charts that I talked about. And the reason is I said that the projection of rates according to the market has changed. This used to be about 96.4, and this remaining percentage was for a 50 basis point rate cut. Now you can see here, it gives you the current target rate. The Fed has a target rate, not an actual rate. Okay, so when they say they cut by 25 basis points, the rate will go from 400 to 425 or 4% to 4.25%, down to what this is implying, which is 3.75% to 4%. Everybody in the markets talks basis points. So 375 basis points is 3.75%. But then you can compare to where things used to be. Okay. So here's where it is today. Here's where it was on the 14th. Here's where it was on the 8th a week ago. And here's where it was 2 weeks ago. And you could follow this as to what the progression of the anticipation has been priced into the markets. And then lastly, one of my favorite tabs is the probability tab. Okay. It shows you what the market is expecting. So right now, if we go just to the end of 2026, the market is expecting 1, 2, 3, 4, 5 rate cuts through 2026, and then nothing else. Now, granted, these are very small probabilities, but it's obviously a long way out, and things change as you get closer to the meeting. So this is a very important thing for people to watch, and you only get it from the CME Fed Watch tool. You see people on TV always saying, well, the market is pricing in a 97% probability. This is where they're getting it. They're not doing any fancy math. They're getting it from here. At least this is where I'm getting it when I'm on
Yeah,
TV
no,
talking about this
it's
thing.
the single most clicked on page on our website.
Yeah,
And like you said, it's quoted everywhere on the financial news networks
yeah.
and everywhere else. So I know we, like you said, we definitely wore our welcome by a bunch of minutes. But I think it was good. I think we covered a lot, Bobby, and like I said at the onset, I always enjoy doing these things with you. It's always interesting. So I've got some time. I've got a little bit of time if you do, if there are some questions.
Yeah, while we're waiting for questions to load up, I do want to talk about this Invite a Friend program. If you invite a friend to sign up for Plus 500, you unlock bonuses. You have to complete at least one trade. There are, other things involved to unlock those bonuses, so you should find out what those are. But you'll receive a $100 commission credit bonus once your invited friend starts trading. And then your fifth friend earns you $300 in cash. I'm going to tell you guys, you should tell your friends about this platform because, again, it's one of the only ones that gives you unlimited demo with live prices. That was one of the things that got me excited to work with Plus 500 is because I never heard of that before. So you get to actually work with live pricing. That is a massive, massive advantage because the demo prices, they're delayed usually. And it's not easy to see what you're going to be doing or how you're going to be performing without getting into actual live prices. The second thing is you guys should go live as soon as you can because of the micro contracts, right? It feels different to have real money. I promise you, it feels different. You may walk away from a demo trade and say, oh, wow, I walked away, I went and got a cup of coffee, came back, I'm up a lot of money, but you may be missing how it went against you and then went your way and you just didn't see it. And you won't do that when it's real money. Even the smallest amount of live trading makes a difference in your psychology. So when you're ready, you should try it. So anyway, take advantage of this program if you can. All right, unless you guys have anything else, my recommendation would be to reach out to Plus 500, suggest new ideas for more of these shows on futures. We'd love to do more of them. Craig, any last words?
No, again, I want to thank you, Bobby. I want to thank Plus 500 again. And most of all, I want to thank everyone who we still have a fair amount of people that stayed with us the whole time, even though
Yeah.
we went way over. So hopefully that's a good sign and you got something out of this. So a sincere thank you to everybody.
Yeah. Thanks, guys. Thanks, Craig. Thanks, Plus 500. And we will see you guys in the next one.